Today, I have quite a few SaaS metrics to cover, kind of a lightning round of SaaS education to get a little taste of all the different metrics that may be applicable to your SaaS businesses. So let's dive in first with the cost of ARR. And this is one of my favorite metrics. It's a sales and marketing efficiency metric, and it measures the cost to acquire $1 of net new ARR coming into your business. And it's also known as the SaaS CAC ratio. So the cost of ARR formula is simply sales and marketing spend, so those expenses fully burdened, wages, taxes, commissions, etc., divided by net new ARR. And that gets the cost of net new ARR for your business. If we summed up our sales and marketing expense, that was $269,000. And then we brought in $265K of new business through new logo wins and expansion on existing customers. We divide that into 269, and we get, in this example, $1.02 to acquire $1 of ARR, which is actually pretty decent. The next one, Sas Magic Number. So it measures the relationship between annualized revenue growth and our sales and marketing expense. So we get revenue growth per $1 of sales and marketing spend. The formula for this is our current quarter's recurring revenue minus our previous quarter's recurring revenue times 4 to annualize it, and then dividing by the previous quarter's sales and marketing expense. So quick example, let's say we had 54K of recurring revenue in Q2, 36 in Q1. We subtract those two and multiply by 4 to annualize and divide by our 90K of sales and marketing expense in Q1. So this results in 80 cents of recurring revenue generation for every sales and marketing spend. Sas Quick Ratio. So with the Sas Quick Ratio, it measures the bookings growth versus bookings contractions. So the Quick Ratio formula, on the top, we have our bookings inflow. So this is the new MRR and expansion MRR coming into our business. And then in the denominator, we have downgrade MRR, so customers who are, say, dropping seats, dropping modules, and then, of course, churn, customers leaving us. So again, bookings inflow on the top, bookings outflow on the bottom. So if we brought in 150K of new business, we expanded our existing customers by 225, we lost 75, we had downgrades of 15, so a result of a 4, which is actually a good number to have above 4. Customer acquisition cost, or CAC. CAC is a sales and marketing efficiency metric, and it measures the total sales and marketing expenses associated with acquiring one new customer. So the formula is pretty simple. Again, it's sales and marketing expenses in the numerator divided by our new customers acquired or our new users, whatever unit makes sense to you. This is a pretty simple equation to understand. So sales and marketing expense dedicated to new business acquisition divided by our new customers won. So in this case, we're a mid-market enterprise deal, 10K CAC per logo. CAC payback period. So with this one, it's the number of months required to pay back the upfront customer acquisition costs after accounting for the variable expenses to service that customer. So a lot of words there, but essentially it's saying, hey, if we put up this money up front, how long does it take before that customer, through the revenue we receive from them? We're looking at new logo acquisition, so just new business coming in, not expansion. We need to isolate our recurring gross margin. So the CAC payback formula, again, we have CAC in our numerator, and then we're taking the MRR. So quick example, say our CAC was 37,000. We're getting, with this new batch of customers, about 5,000 MRR per month. My recurring gross margin is 80%. Divide the two, we have a 10-month payback period. So when we hit month 10, we finally paid off all the $37,000 of CAC, and now we're going to begin making profit on that customer. So then the next one is lifetime value, the revenue and margin that your company receives from one customer over the lifetime of that customer. We need new business coming in, we need our new logo counts, and then our gross margin, specifically our recurring gross margin that we're going to isolate within our overall gross margin. So we're taking our ARR times our recurring gross margin percentage divided by our annual percentage churn to get LTV. Let's say our ARR is 10,000, cohorts coming in, our recurring gross margin is 85%. So we multiply the two, divide by our dollar churn, and we get, in this case, 85,000 of LTV. And again, SaaS metrics not as good used in isolation. This could be good to us, bad to others, and that's where you want to then compare LTV to CAC to see, hey, how much can I spend on a customer to acquire them? So churn, obviously a big one. I look at downgrades and churn for this. and then we are going to compare it to our MRR. So dollar churn formula. So simply, right, this is the lost MRR and say the current month, say we just closed out June, so the lost MRR in June, and compare that to the previous month's ending MRR. Let's say that's May. And that gives us our monthly dollar churn. So that's important to note. That's just our monthly number. If we're measuring like this, you need to annualize it by multiplying by 12 to get an annual churn number. So an important distinction there. Pretty simple calculation. If we lost $5,000 of MRR in February, divide that by the 100K MRR ending balance as of Jan, and we get 5% monthly churn, which then, of course, if someone said, hey, what's your annual dollar churn? I would say it's 60%, which would be pretty darn high. Our retention, that's the amount of the subscription revenue that you retain from your existing customer base. And I do want to point out, right, there are two types of retention that we measure. One is gross dollar retention. So that's the dollar retention after accounting for churn and downgrades only. So just our existing customer base and how much do we retain from them. The next step with that is net dollar retention, or NDR or NRR, or even when we talk about net negative churn. In this case, we look at our churn and downgrades plus the expansion from our existing customers. That's where it can push us above 100%. Whereas GDR, gross dollar retention, it's always going to be less than 100%. So two important numbers to measure. So the GDR formula, again, in the numerator, we have churn and downgraded ARR or MRR divided by the previous month's total. And then we're doing minus that to get, say, a number that's going to say 90%, 95%, something like that. So a quick example. So let's say in July we churned 12,000. We had 3,000 to downgrade, so 15K of dollars going out the door. Our ARR balance at that point in time was 600K, and we take 1 minus that, and in this case, we get 97.5% GDR. And again, this is monthly GDR. Excuse me. So we'd multiply by 12 to annualize. Next, the rule of 40 growth, great cash flow, and that's the point of the rule of 40, a health metric. So it's the trade-off between profit and growth. So the rule of 40 is pretty simple. It's our growth percentage. So that can be total revenue or recurring revenue, plus our profit percentage equals our rule of 40 number. So the rule of thumb and what investors like to see is that number totaling 40 or greater. And then we're deemed, you could say, quote, an attractive business or attractive investment. To calculate this metric, we are looking at our subscription revenue growth and then our profit margin, which in this case, I use our EBITDA margin. So earnings before interest, taxes, depreciation, and amortization, which is kind of a proxy for our cash flow. So rule of 40 example. So let's say we're July year to date here and our EBITDA for the year is 32%. So that's our profit number that goes into the rule of 40. And then I looked at our recurring revenue growth year over year and we're at 14%. So 32 plus the 14% equals 46%. Above 40, that's great. Cohort analysis, this is such a big subject, but it's a framework for customer retention and lifetime value. It provides an understanding of the why, how, and when of our customers' actions. It's measured via logo and dollar retention. So at its most fundamental, it's looking at our January customers and say in this example, we acquired 150 customers, and then we follow them through time. January acquisition in February, we had 147. The next month, 143, 142. So for each month of acquisition, we're measuring what happens to them. And then finally, I know we've gone through a ton here, but what I call kind of the foundation of financial transparency, right? To get to this level of say, financial maturity, it doesn't happen overnight. You kind of have to take small steps. First, it starts with accounting. And I know that's kind of a boring subject, but it's so important with this is your correct chart of accounts, your coding expenses to the department level so you can produce the proper SaaS P&L. So it starts with good fundamental accounting. Otherwise, if you just produce this big P&L with 50 line items on it, it's very difficult to manage your business. So good chart of accounts relevant to a SaaS business, code your expenses to the department level, and then also make sure you have the proper revenue recognition in place. Those are 3 key areas that I see are common weaknesses within SaaS businesses. That allows you to create a nice SaaS P&L to manage your business, and then ultimately the metrics and the unit economics to proactively manage your business so you know where you're going, you know what to adjust.